you have to be committed and know that even if it's just a little bit, get in the habit of doing it. Number two, you have to know your risk tolerance. And I, as a fiduciary, will make recommendations that I think are in your best interest. Doesn't mean you have to accept them, but I am not going to put you in something that is outside of your risk tolerance. So that is going to be one question I am going to be asking you a lot, because I want you to be able to sleep at night and you want to be able to sleep at night.
Welcome to the Build Wealth Your Way podcast, where fearless women take charge of their financial futures. Get ready to tap into your potential, embrace your leadership, and join a community dedicated to your success. Each week, we'll dive into empowering conversations, expert insights, and actionable tips to help you build the life you've always dreamed of. Don't settle for ordinary. Let's shape extraordinary together. It's time to rewrite your financial story. Tune in now and let's start building wealth your way.
Build Wealth Your Way is sponsored by PCMA, home of ProspHER Success Hub, a 3-in-1 business coaching program for women.
Good afternoon,
Hi,
sweetheart. How are
I'm
you?
doing great. How are you?
I am fantastic. I am happy that I am on the back end of some projects that were taking up a ton of time. So I get to spend more time with
Nice.
Build Wealth
Yeah.
Your Way.
Yeah. Isn't it nice?
Yeah.
You have all of these things and it's always in the back of your mind and you know you have to get to them, and it's just kind of like an anchor. And once you feel that anchor is, kind of loosening a little bit, it's like takes such a load off, knowing that you got your projects are almost come to completion. So that's a great
Yeah.
place to be. Good for you.
Yeah, it's a feeling of accomplishment. And I will tell you, when I was thinking about this topic today, Investing 101,
Yeah.
I kind of went back in my head to my early investing days and how I got started in real estate investing. And I'm going to be curious to hear about
Yeah.
your entry into the traditional side of investing. But I want to set this up for our listeners today, Gayle.
Okay.
So, one of the beautiful things about our podcast, Build Wealth Your Way, is that we get to talk about helping women build wealth from two different lenses.
Yeah.
And so that's going to shine through today, given that you are a wealth manager
Yeah.
by trade, like
Yeah.
literally, this is your profession,
Yeah.
and you help people every day with traditional investment vehicles. And I have the wonderful fortune of having been a real estate investor since 1993.
Yay. Wow. 32 years.
And
Wow.
and I
1 years.
today specialize in helping real estate investors. I'm an investor myself, and I help on the commercial and residential side of things. So we get to talk about
Yes.
investing from two different lanes. I
Yeah.
love this.
No, that'd be fun.
Yeah, yeah.
There's a lot about the real
So
estate side I am just totally kind of a novice on. So I'm anxious to hear it.
yeah. Well, I think one of the greatest places for us to get started is in kind of thinking about we've talked about this on previous episodes, but
Yeah.
just for those who are maybe tuning in for the very first time, we have talked about the fact that when it comes to women and wealth, we are maybe more behind the wheel.
Mhm.
Well, we are farther behind than our counterparts
Right.
in
Yeah.
terms of investing overall. And when it comes to the wealth building portions of this, whether it be creating companies that create value or simply putting money in the stock market, we will take steps, but we're not necessarily taking big steps. We're more cautious than maybe we should be.
Yeah.
So I hope that by the end of this episode, we are motivating the listeners. We hope we motivate you, ladies, to make some earnest steps, to be intentional about building wealth, and to reach out to some pros so that you can
Yeah.
either get things started or accelerate the things that you have started.
Right. No,
Does that sound good?
that is a great way to start it out, because I think everything today, it doesn't matter if it's real estate or if it's investing or if it's farming, whatever the case might be, technology has made things move so fast and things get so complex, and there's so much information out there that's available to us at the snap of our fingers, and it can get quite overwhelming at times. And so sometimes when you just have all of this information thrown in your face, sometimes we just shut down and we don't do anything. And so the best thing to do is just reach out to people and get clarity, and hopefully this will help get some clarity. It could cause some more confusion, which is okay, because that just means that there's information that's out there that you didn't know that you need to find out more about. So yeah, so hopefully reach out to us, or if there's someone else in your network that you're comfortable reaching out to, do that. It's a starting point on your
Yeah.
way to become better educated.
Absolutely, absolutely. So, Gail, let's start with you on
Yeah.
the traditional side of things. I've said it a few times, but maybe for the listeners, they should hear a little bit about what you do and how you got started with what you do.
It's interesting because I think back in college, if you were to tell me that I would someday be a wealth manager, I would have said, there is no way on this side of earth that I would ever do that. Because I got to tell you, my brain doesn't always operate like a CPA or an accountant, or, things that numbers, I can't go from A to D just like that. I got to go to A to B to C to D. And so I thought there's no way I can do that, because and plus it wasn't my cup of tea. But then I realized that really a part about being an effective wealth manager is basically you're a relationships manager. You're working with your families, with your clients, on helping them understand what's important to them and how to plan for their future and their unique situations. Once you get that part of it, then it doesn't matter if it's bonds or stocks or real estate or whatever. Those items are just tools to help you
Right.
get to where you want to be. But it's
Mhm.
all about figuring that out. And so that's what I look at being a wealth manager as, more about being a relationships manager. And then I bring in my team of experts that are day in and day out. They're studying portfolios, they're studying, ETFs. They have their nose to the grindstone. And I go to them, I'm like, this is what my family has, my client has. This is what they're looking for. Let's put together a strategy. What do you think is going on right now? Because again, if I'm doing that, I'm not going to be able to manage my families, right? I just don't have the bandwidth to do that. So I need my team of experts to help me. So being a wealth manager to me is really about helping families live the lifestyle they want when they get to that retirement age, and then also build up so that they can get to the point that they can retire comfortably.
I like that. I like that. My story is not, I guess I am like you, kind of like an unlikely real estate investor. I didn't
Yeah.
necessarily plan to get into it. As a matter of fact, all those years ago, what happened was I was approached with an opportunity to buy a distressed home, and we can talk about distressed properties later. And I myself was living in an apartment, so I was not a homeowner yet
Yeah.
myself.
Okay.
But I got this investment opportunity, and if I am one thing, I am opportunistic.
Yeah.
I have been opportunistic since birth. I think leverage might have been my first word besides mommy and daddy. But I saw it,
Yeah.
and I could, and numbers make sense to me. So something that I can purchase for $100, I can add $20 to it, and I can sell for $200,
Yeah.
just clicks for me.
Yeah.
Now, real
That's great.
estate investing is not that simple.
I was going to say,
As a
really?
Gosh, no.
Come on.
As a matter of fact, you and I were talking before we started recording, and I said that if I had to describe all these years what real estate investment was like, I would say real estate investment is like a tricky woman.
Yeah.
She is alluring, she is
Yeah.
enticing, But man, if you don't know what's going on, she will pull the rug from under you. She is a tricky woman. So,
It sounds like a song somewhere in there,
oh my
Darice.
gosh, yeah. I bet I can find one. I'll add it. I'll
And
try to find
chosen
one and
one.
add it to the
There
podcast.
you go. Yeah.
But all those years ago, I got started because numbers just made sense to me. And since then, I have been involved and am now involved in real estate today. Real estate investors are primarily my clientele,
Okay.
and I operate on the residential and commercial side. I, in my own portfolio, in the last 1 year, I have been involved in fix and flip deals. I have been involved in buy and hold, short term rentals, mid-term rentals, wholesaling, and all of it successfully because of some things that I'm going to share today in the
Yeah.
podcast.
And when you said that, the word that came to mind, there's like two words. One is risk, which is part of even traditional investing as well. But when you're looking at, buy and hold or selling short, or I mean, it's all about risk. But what I envision, just much like in the traditional side of investing, much like the real estate side, I imagine it's like knowing your risk tolerance, what you're comfortable with, but then being able to manage that risk. Because life is all about risk, but it's not about reckless risk.
Yeah. Yeah, it's calculated, right?
Yeah.
So that's actually a great place for me to start. So I'm going to run down like some beginner steps for people who are
Perfect.
interested in real estate. And then I'm going to have you do the
Okay.
same. And number
Yeah.
one piece of advice I would give to someone who wants to begin in real estate is to do an assessment and understand your why.
Yeah.
So, the number one most popular thing I get from people who want to start in real estate investing is, oh, well, I want to amass wealth. I want to build wealth. I want to be rich, right?
Mhm.
And that is still broad. What does being rich and building wealth mean to you? And the
Mhm.
reason I think people should spend some time here is there are so many times in this journey of being a real estate investor where it is difficult. There is, no matter how many books I read, how many courses I take, how many people I talk to who are in this space, there is no blueprint for becoming a successful real estate investor. As a matter of fact, you're going to lose. You can plan to lose more than you gain, and it takes time to
Yeah.
know all the things you need to know. And therefore, because you're going into this, you have to know why this is important to you, or else just go ahead
Yeah.
and write me a check for $100,000 and sit down and watch me work,
Yeah.
because you got to know your why. But then
Exactly.
along with that, your why is going to hopefully help you understand what your limitations are. And you said it best, your risk tolerance.
Yeah. Yeah, absolutely. You made something I want to kind of elaborate a little bit on, because you talked about people get into real estate because they want to become rich, right? And
Mhm.
I think that's the same way with a lot of things. But if I say the name Charlie Munger, do you know have you heard the name Charlie Munger before? So
Yes, yes,
so
but for
basically,
everybody else.
yeah. So yeah, Charlie was Warren Buffett's right hand man, good friend. And he made the comment, he said, I never intended on getting rich. I just wanted to be independent. And so I think that this is, and we've said this before, and if this is going to be my mantra, it's about being able to do what you want, when you want, with whom you want, for as long as you want. That's the definition of being wealthy. And so whether you're investing in real estate or the market or cryptocurrency, whatever the case might be, it's not about rich, it's about independence. And I
Mhm.
think that gets back to your, why, to my why, and should be everyone's why.
Yeah, I like that. And I love that it is a holistically simple way of thinking about it.
Yeah,
And it crosses all the lines, gender, race, all of it. It
absolutely.
is choice, it is freedom,
Yep.
right?
Love that. Yeah.
And so understanding your why is big, your risk tolerance is big. And then
Yep.
also, along with step one, you need to do a self audit. The number of people who run up to me during the day, during the week, during the hour, who talk
Yeah.
about becoming real estate investors is almost comical anymore,
Really.
because there has been no thought at that stage of talking to someone like me of what you really bring to the table. Do you know who you are, to be able to know your strengths, to be able to know how to discern thing A from thing B? And here's what I mean. The very first thing someone is typically going to do when they think about real estate investing is they're going to start studying and researching things.
Mm-hmm.
But how do you know what things
Yeah.
you're researching that are going to be good and aligned with who you are? Are you someone who should be using strategy A versus strategy B versus strategy G? There's a huge a self-awareness piece
How did you
that,
figure that out?
well, like I said in the very beginning, numbers make sense to
Yeah.
me. And leverage and opportunities and the ability to discern an opportunity is just something I'm naturally gifted at, right?
Yeah.
So for me, I know based on who I am going to be great here. I'm going to be terrible over there. And here's the thing, if you do know you're going to be terrible over in one particular aspect or area of real estate investing, then that just means that you're going to need to lean on others more over here than over there. And I'll give you a practical example. I have done and been involved in fix and flips where we purchase a home that is in need of repair. We add the value to make the
Mm-hmm.
repairs, bring it up to market value, and then we sell it. Okay.
Mm-hmm.
That's the most easy way I can explain a fix and flip. However, don't put a hammer in my hands.
Yeah.
Don't ask me to measure a room. Don't do
Yeah.
that. That's not
Yeah.
my calling. That's not my gift.
Yeah.
So I understand that if I'm involved in a fix and flip projects, I have to lean on contractors
Yeah.
more so than anybody else. And I have to lean on experts, which means that at the end of the day, my margins are going to be slimmer, meaning I'm going to be less
Yeah.
profitable in those areas. And that goes back to self-awareness.
Sure. So if I'm hearing you from what this is what I hear you say is one, you help navigate those strategic decisions by one, knowing the numbers, running the numbers, and two, knowing your capabilities enough that you have an honest discussion with yourself. And then three, if you do have to bring in outside resources, you better make sure they're very well vetted, because otherwise you have to add in a factor of a screw up factor, right? Most people
Absolutely.
don't add that screw up factor in there. So it'd be
Absolutely.
very easy to lose money on a job because of what some contractor did. And believe me, I've worked in the contracting world. It is not a place for the lighthearted. And you
No.
you kind of have to have, if I can say, you got to have some kahunas to deal with that. You really do.
Yeah, again, yeah, and that's what I mean by you have to really understand who you are,
Yeah.
what your gifts and talents are. The number of people that here's the thing about real estate investing that is almost a disservice to the space. Finding a deal is hard, finding money is easy.
Mm,
I'll
yeah.
say that again. Finding a deal is hard.
Yeah.
Finding money is easy. So what some people do is they rush once they've got a deal to go and get the money to finance it. But the truth of the matter is if you haven't really done your due diligence in terms of what you can manage and can't manage,
Yeah.
then I see a lot of people get into trouble.
Yeah.
I see a
Yeah.
lot of people get
I
into
bet.
trouble. So that self-awareness, that
Yeah.
risk tolerance is big, understanding how
Good.
to research, and then you took it away, building the right team
Yeah.
is next. Because I have literally written $10,000 checks and not seen that money come back.
Yeah. Oh, it
It
happens.
has.
It happens more often than not, doesn't it?
It does. It does. So you mentioned kahunas. I'm going to say it differently. This business requires a lot of damn assertiveness and aggressiveness as a
Yeah.
woman. And
Until I've been in the trades business, because I actually was thinking something else, but I'm like, no, I can't really say that. So that was the nicer version of what I wanted to say.
Yeah, yeah. It's funny you say that. So, like, I meet people and people have like a certain, I don't know, persona or what have you of me. And usually within 15, 20 minutes or so, I'm like, because I see them thinking of me one way. Oh,
Yeah.
she's so sweet. No, no, actually, no, no. That's not a word I would ever use to describe me. Nope. Mm-mm, doesn't fit,
Yeah.
doesn't work.
Yeah.
And it's because of the types of
Yeah.
industries I've been involved in and the kind of deals that I've been involved in. So I would
Yeah.
say going back to the steps, know your why, be able to assess your level of risk tolerance, understand who you are, what you bring to the table, figure out the right strategies, and then build the right team. And we can tease that out a little bit more, but I want to know from your
Yeah.
perspective, because when I think about the markets and traditional investing, my God, it's like the world is so big in that space. Like there's so many vehicles. And I
Yeah.
know most of us probably start off by an introduction to a 401k at work.
Yeah.
So, okay, here we know a little bit about mutual funds and we're off to the races.
Right.
How do you
Yeah.
suggest people start?
Well, I think one, I think it's important that they do start somewhere. So if you are working and you have the ability to invest in a plan put forth by your employer, take advantage of that, especially if they're matching. I mean, if they're putting money, do not give away free money. And even if it's just a little bit, it's getting into that habit of saving and investing that is going to do probably one of the biggest services you can do for yourself in the long run. All right. So that is one of the first things. But there are so many different products out there, and you can break it down into the equity portion of it, which is, you are buying a part of a company, like you are investing in a company. You might just hold a itty bitty little share of it, but you are an investor in that company. The other side of it is the debt side of it, or what we call fixed income. And so that means that a company, let's say it could be a large corporate, like there's corporate bonds that are being offered, and it might be a lot of times they're banks. So let's say that Chase is they want to fund something, so they need to raise money. So they get individual investors to basically give them a loan to raise money, and then they promise to pay you back a certain amount with a certain amount in income, or an interest rate after a period of time. So that's kind of like the fixed income. So you often hear about 60/40, meaning that really comes down to risk. So if you have a portfolio, a 60/40 might mean you got 60% in your equities and 40% in your debt. And as you get older, you want to be more conservative. So you might do, 40% in equities, 60% in debt, or even change it even further up. But those are like the two biggest assets that people have. And then there's obviously the alternative assets, which can be crypto, it could be precious metals, real estate. There's all sorts of things that you can invest in. But before you even get into the products of what's appropriate, it really goes back to something that you said, and that is, you need to know why you're doing it. You need to know what your why is. You need to know your time frame, because your
Mhm.
time frame is going to have a huge impact on what product you're investing in. But I think the one thing that most people do not know, or do not look at investing from this lens, is we always look at it from, every investment should be viewed through the lens of a tax decision. And what I mean by that is, especially if you're looking in, there's really three buckets. So when I work with a client, I break their investments down into three buckets of money. So you have your pre-tax money, which is going to be things like your 401k, 403bs, your, all of those qualified monies that you have. A lot of times they're your IRAs, those types of things. Those are things that you've made a conscious decision to, say, I'm going to not pay my taxes now. I'm going to wait to pay them on down the line. And you do that. It's like you're basically benefiting from the harvest, right? You're a farmer. You sow your seed. You're not paying for the seed now. You're going to pay for it once the harvest comes. And that's really what you're doing on a pre-tax bucket. You're going to build this up, and then you're going to pay the taxes at the end of the day.
Mhm.
Then you have your middle bucket, which is your after tax dollars. And so those are going to be things that you've already, it's like you're checking your checkbook and your savings account, but you want to get a little bit more for that. So that might be your brokerage account. Those might be things that you've kind of squirreled away somewhere, and you're just saying, okay, as opposed to buying, a new car, I'm going to, buy a used car, and then I'm going to invest the rest. I'm using after tax dollars and I'm investing. So that after tax means that that growth of that is going to get taxed on at a later point in time, and many times that comes in the form of a capital gains. All right, so you have a short term, which is less than 12 months, and long terms, and so it's a different tax strategy than your pre-tax. All right,
Right.
your third bucket is your no tax, and so this is one where your Roth IRAs are kind of come into play. So it's basically you have taken money out, you've already paid the taxes, and then you open up a Roth account. What that means is that you let that money grow and grow and grow and grow, and it will never be taxed. The government has set it up that their growth, your principal is not taxed, and your earnings aren't taxed. And so that's a really attractive bucket to be in, especially if you can put money in right now, because it can grow tax free. Other things that would fall into that would be insurance proceeds or loans on insurance policies. Those are not taxed either. So when I work with clients, I really help them figure out, where is this money coming from? Because in retirement, the two biggest expenses a retiree faces is healthcare and taxes. And if you make a decision in retirement, one little decision on taking money out can have it's just like you're tumbling down, and it could have a multitude of tax consequences that you were not prepared for. So before
Yeah.
you even get into the products, you need to look at how you're investing things from a tax strategy. And that's something that we really focus heavily on.
It's interesting you say that, because in the world of real estate, a novice investor is attracted to real estate investing because of four typical areas: because of cash flow from the
Mm-hmm.
investment, because in real estate, the expectation is that there is appreciation.
Yes. Yep.
There is the loan pay down. So if you have had to take out a mortgage or a loan against the property, the benefit to an investor, the way they think about it is your tenants are paying the loan down. Not necessarily you, but your tenants. That's
Yeah.
one thought.
Yeah.
But then the other thought is around tax advantages.
Okay.
And it's interesting to me, the tie-in between what you're saying in the three different areas of taxes, because the way real estate investors usually do it or think about it is okay, I'm going to see this investment property as a tax write-off, right? So those contractors that we mentioned a while ago, okay, well, it's fine because that was an expense that's tied to a write-off. The problem, though, is that a lot of investors, and these are your more astute investors, at a particular time as you're growing a portfolio, you've got to consider how those gains are appreciating.
Mm-hmm.
And there's going to be a tax bill at the end of that thing, right? So
Yeah.
whether you sell it, right,
Yep.
whether you buy it, fix
Yep.
it up and sell it and there's a gain, or
Yeah.
whether you hold it over the long haul to sell it later or do something, there are tax consequences. And I don't think we on this side spend a lot of time thinking about it,
Yeah.
so much so that I got a call from someone, oh my gosh, this was a couple months ago, and she was a heavy real estate investor. She was a high income earner and
Okay.
had gone into real estate investing specifically because she wanted the ability to write off some things to kind of mitigate her tax
Sure. Sure.
bill. But she hadn't put all the considerations together. And going back to the comment about the team, she didn't have the right people on the team. You and I were in a workshop not too long ago that you hosted where we learned by the time your CPA gets the data for them to be able to do your taxes, the decisions have been made and it's
Yeah.
too late
It's too
to
late.
save you, right?
Exactly.
So I'm
Exactly.
bringing I'm bringing all this up because even real estate investors need to be more cognizant of tax consequences on the front end. We tend to think about the benefits, but there are also some offsets and some other things that have to be
Yeah.
considered. So you really have to have the right people on the team, people who can talk to you about tax consequences. And specifically, if you're generating revenue from all these different sources, so you have W-2 income and you
Oh,
have
absolutely.
investment income and you're in the markets, my God, you need some good people on your team who are talking to one another.
And here's the other thing too that I don't think people factor in the considerations. I mean, the high net worth people probably are, and business owners would have a better chance of factoring this in. But there's a thing called their standard deduction.
Mhm.
So right now, for a married couple in 2023, it's like $27,000, and I think for a single, it's like almost 14,000. So what that means is that you have automatically the government gives you $14,000 that you can have as deductions. And if you're less than that, then you don't need to what they call itemize. So the only way you're going to be able to take advantage of losses in your business or losses on real estate is if you itemize.
Mhm.
Otherwise, you're just going to put that all in the standard deduction. So I say that for people to keep in mind that you really need to have an understanding of, are you going to have enough money or enough losses to make it worthwhile to itemize? And I'm telling you, I mean, $27,000 for a married couple filing jointly, or 14,000 for a single, that's quite a bit of money. Now that is scheduled to change in 2026. It's unless Congress does anything, it's scheduled to go back down. But I just want people to keep that in mind because nobody really talks about that.
Yeah, I think there's a lot there's a lot people don't talk about when it comes to
Yeah.
investing, but the right people on your team and the team needs to talk to one another
Oh
and
my
that ties
gosh.
back to your end goal. Something else I think that is important. So you definitely come across folks in your space who are thinking about the long term, but I want to talk to you about people who haven't gotten started yet. Maybe
Yeah.
they are, for whatever reason. I mean, this entire podcast was created to speak to women who haven't had a straight path to wealth. So
Yeah.
there will be those that listen to this podcast to say, okay, this is all fine and good, but maybe I'm in my 40s and I have not done the things to get started. What would be some tips or
Sure.
ideas or strategies you would have for somebody that is starting off a little bit later in the game?
Okay, that's a great question because I had this come up with a client not too long ago, and I asked her, I'm like, so what do you want your money to do for you? She's like, well, I want to be able to put it in the market, and I don't want to be able to lose money. I'm like, okay. And she goes, then I want to be able to access it like at any time I want. Okay. She goes, but then I also want to be able to like beat the market like more times than not. And like, you know what? If I could find that product, then I would definitely share it with you, but it would be from some beach somewhere because that product doesn't exist right now. But what she was talking about is there's really three things that your investments need to do for you. There's safety, so that's like making sure
True.
that you put it in there and it's not lost. There's liquidity. How much money do you need to take care of those unexpected things that will occur in life? And then there's also the risk, or the longer you have, then you're willing to put things are that you're a little bit more risk taking so that you can get a higher return. And the
Right.
market is the best place to get that done over a longer period of time. So safety, liquidity, and return those three things are really important. So if you are a new investor, just know that, like what I told my client, I'm like, you know what? The good news is we can do all of those things for you, but we can't have $1 do all of those things. We're going to have to
Mm,
break it down so that each dollar is assigned a specific job.
that's good.
So being able to really, look at, and it's going to depend on where you are in your stage in life. So if someone is, maybe in their early 40s, they know that they have a little bit longer runway, so they can be a little bit, they can get a little bit better return, because if the market tanks, they have 7, 8, 10 years that can bring it back out, versus someone that's in their 60s. Yeah, that could really determine or put a damper on when they actually would retire. So looking at where you are in your career and where you are in your whole, how much money you have, is going to really help determine where you put those, where you allocate those individual dollars to be. And then we can determine, okay, well, then we start looking at the specific products that are going to be best for safety, or best for returns, or best for liquidity. And then that's how we kind of build it out.
I'm glad you brought up the time horizon, because the time horizon is something that also happens in the world of real estate investing, right? So we have certain strategies. So let's talk about strategies for just a second
Mhm.
at a very high level.
Yeah.
Because if there's anyone listening to this episode and they've been considering getting into real estate investing, I already know the concepts that they've come across, because they are typically marketed towards newer investors. And that is wholesaling, which is finding a property, usually a distressed property, or distressed seller, and obtaining permission to be able to market that property and sell that property, having never owned it. Okay.
Okay.
That's something that comes up quite a bit for newer investors. It's an easy strategy to use, but a very difficult strategy to win at and execute at.
It sounds
But it's
extremely risky. I
yeah.
mean, I'm just hearing what you said in 3 or 4 sentences. I'm like, wow, you better know your research on that.
Well, it's due diligence. It's due diligence, and
Yeah. Okay.
it's also skill, which is
I get
why it's I have a really good friend who runs a real estate investment club here in the market, and every time I mention wholesaler or wholesale in her presence, she kind of like rolls her
that.
eye,
Yeah.
because she's just so used to it being this flashy kind of Hollywood type celebrity type of vehicle that people
Oh, sure.
like to jump into, but it is not for the faint hearted.
I
But
bet
I
not.
bring that up because it's one of the most popular and well heard of. Then you've got people who are, and this strategy is a quick turnaround. It's a transaction type of deal, right? You buy, you sell it, and there's a couple parties involved. Then you've got people who are doing the fix and flip piece, which again, it's a transaction. I
Yeah.
find a thing, I improve the value, and I sell it. It's quick. So those time horizons are fairly short. Well, you hope that they are. And then
Yeah.
you have you have people who are on the side of a longer term strategy, and those are your buy and holds. But I want to say this, because one of the things that I've been extremely disappointed in from the community out there that is educating investors is in that the buy and hold strategy is typically marketed or associated with it's associated with the type of product that they call passive. And
Yeah.
I
Okay. Yes.
absolutely hate. I hate the
Yeah.
word passive being tied to any real estate, any investment, period.
Yeah.
Because the problem I see with the idea of passive income is folks have a tendency to want to set it and forget it.
Yeah.
Oh, I'll think about it once a year when it's time for me to talk to my CPA. And that is the biggest mistake that I see on my side of
Oh,
real estate investing. And it happens on the commercial and the residential side. And the problem with thinking that real estate is a passive investment strategy is that if you really truly put that thing over there and let that tenant pay every single month, and you're not evaluating, and you don't have a system to evaluate on a regular basis, I can guarantee you're losing money. You're losing
yeah.
money right now in your portfolio. And I don't care where you live and where your properties are, you're losing money if you're never evaluating.
Yeah.
I
It
hate
sounds
it
like a
so
way
much.
to also make the evening news too, because we've seen that, haven't we? I mean, we've seen
True,
those horror
true.
stories.
Yeah, yeah. You go to pass on a
Yeah.
portfolio of investments and you think it's worth this, and here by and large, it's not. And you left money on the table. That's the piece
Yeah.
that I really want to drill down into. If you're not
Yeah.
evaluating, if you're not determining whether or not you should exchange that property for another, whether you should be in a different asset class, if you're not considering the fact that there is a depreciation also happening in that property value, then
Sure.
you're losing money. And so I
Yeah.
want to make sure that I disassociate the word passive
Yeah.
with real estate investing. I hate it so
Well,
much.
yeah, and I think too it's similar to what we do in the traditional side of investing is there's a term called tax loss harvesting, and that's when you own individual, stocks, and then you might have some that are gains and you've done really well, and that's going to create a capital gains tax for you. But then you also own individual stocks that are losers. And so you have to be active in understanding who your gains are, who's your loser, so you can sell those off to create that loss to offset the gain. And I would imagine that's the same with real estate, that you have to stay on top of it so that it may make sense to sell a loser because you're offsetting the gains from another side of your portfolio.
Yeah, yeah. So I just feel like there's so much here, and we've spent a good amount of time giving
Yeah.
a wide overview of ideas about how to get started with investing. But I want to ask you, Gail, because I thought about this question. What advice would you have for women specifically, because that's the podcast audience? What advice do you have for women who are becoming investors in the market?
Yeah. Well, I think a couple things that I've probably already touched upon is one, you have to be committed and know that even if it's just a little bit, get in the habit of doing it. Number two, you have to know your risk tolerance. And I, as a fiduciary, will make recommendations that I think are in your best interest. Doesn't mean you have to accept them, but I am not going to put you in something that is outside of your risk tolerance. So that is going to be one question I am going to be asking you a lot, because I want you to be able to sleep at night and you want to be able to sleep at night. So knowing that is not something to poo poo, but a real serious thing that you need to consider. And then the third thing is that before you know whether or not you should be in stocks or whether you should be bonds or whether you should be in real estate, you have to come up with, like you had mentioned, where do you want to go? I mean, you have to have some kind of strategy, even if it's on a cocktail napkin, that you kind of have a vision of what to do, because I can find the products. But I got to make sure that those products are going to work the way you want them to work. And it's going to be, if you want someone to say, hey, can you get me connected with Microsoft stock? I'm like, no, I'm not the person for you. I'm not just going to sell you something without knowing the context of why you want to buy it. So those are some things that I just say, it's more holistic. It's more, you got to have a plan and you got to know you. Very same things that go back to what you started the conversation with is no
Mhm.
different that what I would say in the traditional investing side of things.
Yeah, and what I would say is on the real estate side, especially because it is so alluring and so
Yeah.
enticing and so sexy, if you are hesitating around real estate investing, if you've been researching for the last 2, 3, 5, 12 years, if you think that you should be a real estate investor because your uncle does it, your cousin does it, your sister did it, don't do it.
Yeah.
It's not for everybody. And it's possible that there is a reason you have hesitated. There's a reason you haven't gotten involved. There's a reason you've been sitting on the sidelines. It is not for everybody. And it's possible that there is a better vehicle out there for you
Yeah.
besides real estate investing. However, if you are someone who you truly feel like you have the chops to be able to get involved in a vehicle like this, then you need help. And I would suggest you contact me. I will tell you without a doubt. We can have some conversations around it and I'll give you the truth. I'm not going to sugarcoat it for you. I don't
Yeah.
sugarcoat anything, not even my donuts. I just don't do it. So
Yeah.
if you want an honest conversation with somebody who knows some things, who's been involved for quite a bit of time, then we should talk. And for those that are maybe, even if you do have a portfolio today, but there are some doubts around what you're doing, or you're not certain you're being led the right way, I would suggest you get in touch with Gayle. I
Mm.
love the fact that, you have resources here. We don't necessarily have skin in the game. There is not a
Right.
gain for us to be able to have an
Yeah,
honest conversation with you. And we're here at Build Wealth Your Way specifically because we want to see women win. So I
absolutely.
suggest you contact us. Now,
Yeah,
for those of you who have heard a lot and you want to know more, there are so many more resources that I couldn't share in the podcast today. So I'm going to put them in the
yeah,
show notes. And
that'd be
then,
great.
Gail, I'm sure you have some things that you can share in
Yeah,
the show notes.
because typically we talk about what books would you recommend, and I have several books that I think are important, that some get into the blocking and tackling and others get more into the holistic side of things, but they're great books nevertheless. And I think the one thing that if you're really interested in, there is so much information on these two topics, traditional investing in real estate, that just Google it, go to Amazon, and just start becoming a student
Yeah.
of it. And I think you'll learn a lot, and that will lead you into other avenues and start asking questions. So yeah,
Yeah.
that's the best thing to do, I think, is just become a student.
Yeah, we will have resources for you in the show notes for sure. I can give you some high level books. I can give you some more strategic books.
Yep.
There are websites that I advocate and send people to. There are websites that I do not send people to. So do think about getting in touch with us.
Yes.
But if nothing else, we'll have information for you in the show notes.
Awesome.
And
Perfect.
Gail, it's been
Darice,
lovely.
it has, as always. And so look forward to our next Build Wealth Your Way podcast and talking with all of you again.
Absolutely. And Gail, when you're done with that scarf, I could have used that today for my
You
outfit.
could have. I know. I know. So
Yeah,
I'll
I'm gonna
let you
show up
borrow it.
with a I'm gonna show up with a fancy scarf next time.
There
How
you
about that?
go. Okay.
All right.
Take
Thanks,
care,
Gail. All
Grace. Bye bye.
right, bye-bye. And that's a wrap for today's episode of the Build Wealth Your Way podcast. We hope you're feeling inspired and empowered to take action on your financial journey. Remember, when women control wealth, the world changes for the better. If you enjoyed today's episode, be sure to subscribe, rate, and review us on your favorite podcast platform. Visit our website to stay connected for updates and more ways to accelerate your wealth building efforts. This is Darice Renee signing off. Stay fearless, stay fabulous, and keep building wealth your way. Build Wealth Your Way is provided for informational and educational purposes only. The content of this podcast is not intended to be a substitute for professional financial advice, diagnosis, or treatment. Always seek the advice of your financial advisor or other qualified professional with any questions you may have regarding your financial situation. The information and opinions expressed in this podcast are based on the host's experiences and research. They do not constitute financial investment, tax, or legal advice. The host and guests may have positions in the financial products or securities mentioned, which can change at times. Always conduct your own due diligence before making any financial decisions. No content in this podcast should be considered as a recommendation to buy or sell any particular investment, product, or service. Any investment decisions you make should be based on your own individual circumstances, your risk tolerance, and financial objectives.